A very good day, everyone. Today, I will be presenting two important accounting principles, the consistency concept and the matching concept. These two concepts are part of the basic accounting framework that accountants use when preparing financial statements. They help ensure that all financial information is accurate, fair, and reliable. By following these principles, businesses can maintain professionalism and ethical standards in their accounting work. Let's begin with the consistency concept. This concept means that a businesses should use the same accounting methods and procedures from one accounting period to another. For example, if a company uses the straight line method to calculate depreciation this year, it should continue using the same method next year. By keeping methods consistent, it becomes easier for users such as managers, investors, and auditors to compare results and understand how the business is performing over time. Consistency is a very important because it builds trust and reliability. When accounting methods keep changing, it can cause confusion and make it hard to tell whether a company performance has really improved or if the results only look different because of a new method. So, by being consistent, accountants ensure that financial statements can be compared apple to apple, meaning using the same standards every year. However, sometimes changes are necessary. For example, when a new accounting standard provides more accurate information. In that case, the company must clearly explain and disclose the reason for the change in the financial statements. The maintains transparency and honesty. Imagine a company that uses the FIFO method to record inventory in 2024. If it changed to the LIFO method in 2025 without explanation, the profits may look higher or lower, and that could mislead users. Therefore, under the consistency concept, the company must use the same method unless a change is justified and fully explained. In short, consistency ensures comparability, reliability, and transparency in financial reporting. Now, let's move on the matching concept. The principle focuses on how revenue and expenses are recorded. It states that all expenses must be matched with the revenue they help to generate in the same accounting period. This gives a true picture of the business profit or loss for that period. For example, let's say a company sells a good worth Rm 10,000 ringgit in December and pays us 1,000 ringgit commission to the salesperson in January. Even though the payment happens in January, the commission should be recorded in December because it is related to the December sales. This ensures that the profit for December is correctly calculated. Another example is insurance. If the company pays 1,200 for 1 year insurance policy in January, it should record 100 ringgit per month as an expense for each month coverage, not the full 1,200 ringgit in January. The matching concept is very important because it ensures accurate profit measurement. It prevents overstatement or understatement of income and ensures fairness in reporting. By matching revenues and expenses correctly, accountants show the real financial performance of the businesses. This concept also helps managers make better decisions because it gives a clearer understanding of which activities are profitable and which are not. In conclusion, both the consistency concept and the matching concept play vital roles in accounting. The consistency concept ensures that financial statements are reliable and comparable over time, while the match concept ensures that profits are calculated accurately by linking revenues and expenses in the same period. Together, they promote transparency, ethics, and professionalism in accounting. Thank you for listening.
Good morning, everybody. My name is Hashin Anatlalaki Prakash, and today I will be talking about three concepts of in business accounting. So let's start with money measurement. The money measurement concept means that only transaction and events that can be expressed in terms of money are recorded in the books of accounts. Money acts as common unit of measurement, allowing accountants to record and compare different types of transactions, like buying goods, paying salaries, or earning income. Key points of money measurement is common measurement unit. Money helps convert different things like goods, services, land, and salaries into a single measurable unit, which is currency. Example, a machine that costs $20,000 or RM 20,000 ringgit and a rent that costs RM 2,000 ringgit can both be recorded in ringgit RM. Second is non-monetary items are ignored. Anything that cannot be measured in money is not recorded in accounting books. Example, employee happiness, customer loyalty, or even brand reputation are not recorded. And third, we got ensures objectivity. Using money as a unit of measure ensures that the information recorded is objective and comparable. So let me give an example. Let's say a transaction event for purchases furniture for RM 5,000 ringgit. Can it be measured by money? Yes, because it's 5,000 ringgit. Recorded in accounts? Yes, because there's a currency there. Employee morale. It can't be measured by currency, so it won't be recorded in accounts. Okay. Ignore quantity factors. These are the limitations. Important factors like employee satisfaction, brand image, or company reputation are left out in money measurement. Value changes over time. So the value of money changes due to inflation. So financial statement may not show through current values. So in conclusion, the money measurement concept ensures that accounting deals only with quantifiable monetary transactions, allowing consistent and comparable financial report. But it ignores non-financial aspects that may affect business success. That is for money measurement unit. So in conclusion, everything simple. Whatever that can be measured with money is recorded in the accounts, and whatever can't will be ignored. Let's go with the next chapter, which is business entity. Business entity means concept that means that a business is treated as a separate and independent entity from its owners. In accounting, the business and the owner are not the same person. Their financial records are kept separate. So what are the key points in a business entity? It means the separate records. So the business has its own assets, liability, income, expenses, which are different from the owner's personal items. Second, we got owner's investment. Any money or property that owner puts into the business is recorded as capital, owner's investment, okay, not as the owner's personal asset. And third, we got owner's withdrawals. If the owner takes money or goods for personal use, it is called drawings, and it's recorded as reduction in capital. So let me give you some examples. Example is owner invests 10,000 ringgit into the business. How is it recorded? Recorded as capital because the owner is putting the money in it. Business earned RM 5,000. record as business income. Okay. Owner uses another. Let me give you another example of business entity is owner uses RM 1000 for personal business. Okay. Another example of business entity is owner uses RM 1000 of business cash for personal use. So this is owner is taking money out from the business. So it is recorded as accounting. So the purpose is of business entities helps in accurate financial reporting. Second, makes it possible to know the true profit or loss of the business. And thirdly, ensures clarity and accountability. So in simple words, the business entity concept means that the business and the owner separate in the eyes of accounting. Only the business's financial activities are recorded in its book, not the owner personal transaction. Next, we're going to learn about periodic. Periodic means the meaning of periodic concept, also known as accounting period concept, means that a business life is divided into fixed time periods, usually 1 year, but it can also be monthly, quarterly, or half yearly. Since a business can exist for a very long time, accountants divide its life into smaller, manageable periods so they can measure profit or loss and financial position regularly. Key points of periodic is dividing time. The business life is divided into equal accounting periods. Most importantly, 12 months. Second is regular financial reports. At the end of each period, the business prepares financial statements such as statement of profit loss, income statement, to find out profit or loss. Second is statement of financial position, balance sheet, to know assets and liabilities. Third helps in comparison. Comparing results of different periods help check if the business is improving or decline. Fourth is decision making. Regular reports help owners and managers make timely decisions instead of waiting until the business ends. So let me give you an example of this periodic. Let's say period 1 month. Purpose for small business to check cash flow or sales results. 3 months, it's called quarterly. For companies to report to shareholders. And finally is 1 year example is called annually. For preparing official financial statement and taxes. So let's say example if Korean Burger prepares financial report every 12 months, January to December, it means its accounting period is 1 year. At the end of December, it calculates profit or loss for that year only. Purpose is to measure performance regularly, to compare one period's result with another, and finally, to help management make better business decisions. In simple words, the periodic concept means dividing a business's life into regular time periods, like every month or year, so that it can check profit, losses, and financial position regularly, instead of waiting until the business ends. That is all from me. That is the three concept of accounting. Thank you.
I hope everyone having a precious day. Me, Suryavarman, going to present about accrual and materiality in accounting. These two ideas form the backbone of how financial statements are prepared and how accountants make decisions about what to record and when. By the end of this presentation, you will understand what these concepts mean, why they are important, and how they work together in practice. First one, what is accrual accounting? Let's start with accrual accounting. In simple terms, accrual accounting means that we record income when it's earned and expenses when they are incurred, not when the money actually moves. For an example, if a company delivers a product in December
but gets paid in January. The revenue still belongs to December because that's when it was earned. Normally, accrual accounting compare with cash accounting. This is different from cash accounting, where transactions are only recorded when cash is received or paid. Accrual accounting gives a more accurate picture of how business is really performing, while cash accounting just tracks the flow of money. Most large companies are required to use accrual accounting under GAAP or IFRS. Why accrual accounting matters? Accrual accounting is important because it matches revenue with the expenses that help generate them. This matching principle helps us see the true profitability of a business during a specific period. It also ensures that financial statements are consistent, reliable, and useful for decision making. Okay. Next one is materiality. What is materiality? Now let's talk about materiality. Materiality is about determining which information is important enough to include in the financial statement. If leaving something out or misstating it could influence someone's decision, like an investor or creditor, then that information is considered material. For an example for materiality, a $1,000 error might not matter for a $1 billion company. That's immaterial. But for a small business, that same $1,000 could be significant and therefore material. So materiality depends on the size of the company and the content of the transaction. Quantitative and qualitative materiality. Materiality isn't just about numbers. There are two types, which is quantitative material and qualitative material. Quantitative material is looks at the size or value. For instance, anything over 5% of net income might be considered material. And qualitative material which focuses on the nature of the item. For example, even a small amount of fraud would always be material because of what what it represents. How accrual and materiality works together. These two concepts actually work hand in hand. Accrual accounting tells us when to record a transaction, while materiality helps us decide whether it's important enough to record or disclose. Together, they make sure that financial statements are both accurate and meaningful. Applying them in practice. In practice, this means accountants use their judgment all the time. For instance, they'll accrue unpaid expenses at the end of a period to make sure costs are recorded correctly, but they might ignore a very small expenses difference if it's immaterial. The goal is always to provide financial information that's fair and not misleading. To summarize, accrual accounting ensures revenue and expenses are recorded in the right period, but materiality ensures we focus only on information that truly matters. When applied together, these principles helps
Good morning, Paul Emily. Let's begin the historical concept. with the historical cost concept. So, the historical cost concept means that all assets, liabilities, and expenses are recorded at their original purchase price, not at their current market value. In other words, when a business buys something, for example, a machine, it records the cost at the amount paid when it was purchased. So, if a machine is bought for around 50,000, it will remain recorded at around 50,000 in the financial statements, even if its market value increases or decreases over time. So, this concept is very important because it ensures objectivity and accuracy. So, the value in the books are based on real, verifiable transactions supported by documents such as receipts, invoices, or contracts. This means anyone can trace the number back to evidence, making financial information more reliable and transparent. So, it also helps prevent manipulation of financial statements. So, if accountants were allowed to change values based on current market prices, it would be easier to distort profit or asset figures. By using the original cost, we maintain consistency and comparability between different accounting periods. However, even though the value recorded stays the same, we still account for depreciation, which reflects the loss of value of an asset over time. This doesn't change the original cost, it just shows how much value has been used up. So, overall, the historical cost concept makes financial reporting trustworthy, factual, and easy to compare. It provides a stable foundation for users of financial statements, such as investors, managers, and auditors to make informed decisions. Next, next, let's look at the prudence concept, also known as the conservatism principle. So, the prudent concept requires accountants to be careful and cautious when preparing financial statements. It basically says don't overstate your income or assets and don't underestimate your expenses or liabilities. So, this concept ensures that profits are not recorded until they are certain, but potential losers should but should be recognized as soon as they are likely. So here's an example. Imagine a customer owes your company around 10,000, but there's a chance they might not pay. So, according to the prudence concept, you should record that 10,000 as a bad debt expenses because there's a risk of losing that money. But if there's a potential future income like a possible bonus or an unexpected sale, you don't record it until it's confirmed. So, this concept helps present a true and fair view of the business position, financial position, and it also prevents an overly optimistic picture that might mislead investors or creditors. So, by being prudent, accountants build trust and credibility in financial reporting. It also helps protect stakeholders such as investors, lenders, and management from taking decisions based on inflated profits or unrealistic assets value. So, in short, the prudence concept promotes honesty, professionalism, and fairness in accounting. It also reminds us that it's better to be safe and realistic rather than overly positive when dealing with uncertain financial situations. So, to sum up, both the historical cost concept and the prudence concept are essential pillars of accounting. The historical cost concept focuses on accuracy, reliability, and consistency, ensuring that all recorded values are based on actual proven transaction. Meanwhile, the prudence concept emphasizes caution, fairness, and honesty, reminding us not to exaggerate profits or ignore possible losses. When these two principles work together, they make financial information more credible and dependable. So businesses can make better decisions, investors can trust what they see, and accountants can maintain their professional integrity. For example, when a company records an asset at its historical cost and applies prudence by recognizing potential risk, it presents a more realistic and fair financial picture. So this builds confidence not just for management but also for shareholders, creditors, and the public. In conclusion, these two concepts remind us that accounting is not just about numbers, it's about truthfulness, transparency, and responsibility. They help ensure that financial statements reflect what truly happens in a business, providing a strong foundation for ethical and professional accounting practices. So that's it from me. Thank you for listening. And remember, in accounting, honesty and consistency are always more valuable than optimistic numbers. Thank you.
Good morning, everyone. My name is Suka Somsram. Today, I will be presenting about two important accounting principles which are going concern and objectivity. These principles play a very important role in ensuring that financial statements are prepared in fair and meaningful. Let me start with the going concern principle. The going concern principle means that when accountants prepare financial statement, they assume that the business will continue operating into the future. In other words, we do not expect the business to shut down, sell all its assets, or stop operation in the near future. The assumption is important because it's affect how we record and value the asset and liabilities of the business. For example, if a business buy machinery or equipment, we do not record its acts if the business will sell it immediately. Instead, we record it as something that the business will use over several years. Because of this, we use depreciation, which means separating the cost of asset over its useful life. This matches the cost of the asset with the revenue it helped to generate each year. The going concern principle also affect how we record long-term liability. If the business is expected to continue, we assume it will have enough time to pay this liability over many years. This means we do not need to show everything as due immediately. Another effect of going concern is that we can record prepare expenses and accurate expenses because we assume the business will continue into the next accounting period. So the business is expected to stay stable and continue operation. However, if a business is not expected to continue, then the financial statements must be differently. Asset will have to be valued at liquidation value, which is usually lower than value when the business is operating normally. This situation usually happen when a business is facing bankruptcy or closure. To summarize this principle, going concern help maintain consistency, stability, and trust in the financial statement, and it provides confidence for stakeholders such as investor, creditor, supplier, and employees. Now, let's move on to second principle, which is objectivity. The objectivity principle means that principle financial important use must be based on fact that can be verified and not on personal opinion or guessness. This means every transaction that is recorded must have evidence such as invoice, receipt, contract, bank statement, or vouchers. Accountant must avoid personal views when recording financial data. For example, we cannot increase or decrease the value of sale just because we want the company to look more successful or to show more profit. The figure must represent the actual situation. This principle is very important because it ensures that financial statements are truthful, reliable, and trustworthy. It prevents manipulation of financial important and reduce the risk of fraud. When financial statements are objective, it's become easier for auditor to verify the important. It's also build confidence among people who use the financial statement, such as investor, banks, business partner, and even the government. In short, the objectivity principles support accuracy, transparency, and fairness in accounting. To consume the going concept principle ensure that the business is assumed to continue its operation in the future, which affect how we record asset, liability, expenses. Meanwhile, the objective principle ensures that all financial information is recorded based on reliable and verified evidence, not personal opinion. Together, these two principles help make statement, financial statement useful, consistent, accurate, and trustworthy for decision making. Thank you.